Or you ever do a list for yourself? All right, I got to go grocery shopping. I need some milk, eggs, prosciutto, pepperoni, maybe a little provolone, sausage, pepper. I digress. Well, companies do their own list. And in the case of United, I don't know if it had eggs or pepperoni or prosciutto, but it did have 100 Boeing Dreamliners. They plunked the money down for 100 Boeing Dreamliners, which cost a little bit more than all of those other items I mentioned combined and then some. Jerry Willis has more on that. Hey, Jerry.
Hi, Neil. No provolone here. Nope. United Airlines buying 100 Boeing 787 Dreamliner wide-body jets with an option to purchase 100 more. The airline saying it expects to take delivery of a total of 700 new narrow and wide-body aircraft by 2032. In addition, the company will buy 100 Boeing 737 MAX aircraft jets for delivery through 2028. United shares have been down more than 6% today. Meanwhile, hotel prices are up a little over 3% from last year. Airfare up a whopping 36%. Meanwhile, shares of Dollar General, they are trading just ever so slightly higher here as the company announces a plan to snag upper middle income families tired of inflation. Their Pop Shelf concept caters to suburban customers with incomes of $50,000 to $100,000 with items priced at $5. Currently, those shelves are stocked with holiday items like gourmet chocolates and portobello mushroom jerky. So maybe we could head over there later, Neil.
It's not a bad idea to me. All right, Jerry, by the way, everything Jerry has is always healthy. She's doing all her arugula and, oh, my goodness. But it's working, Jerry. Thank you very much. Good seeing you, my friend. So what do you make of these big purchases? A lot of people look at like a big airliner announcement and similar companies buying other companies. We've been seeing a smattering of that of late as a sign that, corporate America does have the cash and now does have the confidence to commit that cash. Is that so? Let's bring back Jim Bianco at Danielle DiMartino booth. Jim, what do you think? That this is actually a bullish sign for the economy?
I'm going to disagree, and I'm going to have to say no. And this is one of the reasons why in the durable goods order, we usually exclude aircraft because they are special one-time events. Now, don't get me wrong. It's great that, United is buying a bunch of airplanes from Boeing. But if you want to start penciling in higher corporate earnings in GDP because some airplanes were purchased for delivery in 10 years, we've seen enough economic data to show that that's usually not the case.
So let's flip it around and look what they're doing with their personnel, Danielle. Some have announced layoffs. In the case of a few, it's generally around the 2% level. It hasn't gone over that, even though when you hear, a couple of thousand who might be laid off at Microsoft, you realize they got better than 300,000 workers. But we are seeing that, but in dribs and drabs. What do you make of that?
Well, I think, Neil, that we might see more than dribs and drabs once we cross over into 2023. We are indeed seeing layoffs spread throughout the economy. JetBlue came out just today and said that it was seeing very disappointing bookings, and its stock is down big. So I think we have to get through the lagged effects of Fed tightening and what that is on the economy. I follow this website called dailyjobcuts.com. They do a great job. They've already got 105 smaller businesses closing so far this month. For perspective, in November, there were only 131 for the whole month. So we are starting to see pain percolate through the economy, and I would expect that you're going to see a broadening and a deepening of these layoff announcements, Neil.
So, Jim, when people look at the markets now and say they adequately and accurately reflect the degree to which we've been punished already, and even factor in the punishment to come, if Danielle is right, what do you make of that?
I think it misses the point. The markets are driven by one thing and one thing only lately, and that is cheap money from the Fed. And that's why you see, look, I've been in the markets for 30 years, and I've never seen an economic release get the kind of reaction like you've got off of CPI today. No other release has ever produced these kind of wild movements that we've seen in the market.
Why do you think that happened?
And that's because nobody cares about earnings, nobody cares about jobs, nobody cares about GDP. They only want the Fed to pivot and cut rates. And that's why I said the joke is pick good companies and hope they go to hell, because then the Fed will pivot and your stock will go up. You pick good companies and they actually produce profits, hire more people, and then God forbid, raise their prices, you're going to have a problem with your stock in 2023. That's how upside down this world is right now.
Do you think, Danielle, to that point then, that the Fed risks overdoing it? It's going to hurt those companies. It's going to hurt them because we have yet to see the implications of all these rate hikes we're showing, beginning with the 1/4 point one and ending with the 4 3/4 point hikes, and maybe tomorrow another 1/2 point hike. And yet, with maybe this CPI report, we saw the first sign, at least the rate of acceleration is slowing, but that we haven't really seen the impact from all this.
So typically, you know, when central bankers speak of the lagged effect, they're talking about 18 to 24 months. We've seen the Fed raise rates at the fastest pace in modern history. And I think that therefore there's still going to be a lag, Neil. It's just going to be shorter. So by this time next year, you know, the full economy will be feeling the brunt of these rate hikes, especially in the case of Uncle Sam and other corporate borrowers who don't have the cash flow to be able to hold debt at higher coupons, at higher issuance levels. I think we will see pain, and it will be reflected in the markets. Again, if Jay Powell is able to stick around, as he says, until the job is done, which translates into getting rates to a high level, close to 5% on the overnight level, and keeping them there throughout 2023.
So you say keeping them there. In other words, they don't start reversing them toward the end of the year.
I think Jim's probably with me on this. I think that that's the least priced in potential for markets headed into 2023 that expect rates to start coming down quickly and hard.
So what do you tell Jim, let's say a new investor now, been sitting this one out, curious about timing? I guess a lot has to do with their age and their time perspective, but what to do now? And they want to dabble. They want in because they think stocks have been down enough.
Yeah, I think a lot of it has to do with their time and their perspective. You know, if you're in your 60s and, you know, I like to say a bear market is time, it's not price. Will the market make a new all-time high? Yes. But will it make a new all-time high in 6 years? If you're in your 60s, that matters to you. If you're in your 30s, it doesn't matter to you. So if you've got a longer-term time horizon, I'd use weakness to buy the market. But if you're thinking it's going to make a new high next year, that might be a little bit aggressive. And if you don't have that long a period of time to wait for the market to rebound, I would be a little bit more cautious on it.
Yeah, next time I have you guys back, Jim, I'd like to ask about what if your timing is mine like 6 days from now? How does it look? So maybe we can explore that. Guys, I want to thank you both. You really
Options
are
market.
very, very helpful. Looking at the big picture here, the Dow about 44 points, a little more to this.